Lena Shandy purchased this townhouse 7 years ago in Vancouver's largest suburb. Her mortgage payments have just about doubled since.
Just a little bit under half my paycheck. I want to know, at what point does it stop? Do people have to be forced out of their houses?
The Bank of Canada raised its key interest rate by another 25 basis points, hitting 5% for the first time in 22 years.
Past interest rate
Governor Tiff Macklem says core inflation remains stubbornly high and points to signs of excess demand in the economy.
We know that if we don't do enough now, we'll likely have to do even more later. We also know, though, that if we do more than we need now, it's going to be unnecessarily painful.
Which some homeowners say is already the case.
It's not only difficult, it's impossible to upgrade from $700 per month. So we extend the amortization.
From 25 years to 40 years, he says. This is the 10th rate hike in less than a year and a half, all aimed at taming inflation. But now mortgage costs have become the biggest contributor. This economist says that's a price the Bank of Canada is willing to pay.
You're going to have to concede some inflation in some areas in order to extract this inflation elsewhere. They're hoping that this will demand households to make sacrifices in their budgets and to cut back on really the non-essential type of spending.
Even with such cutbacks, the central bank says the economy can avoid a major downturn.
In our forecast, there is a path back to price stability while maintaining growth. So there is no recession.
The Bank of Canada now expects to reach its 2% inflation target by the middle of 2025. That's about half a year later than it previously projected. And to get there, the central bank isn't ruling out more rate hikes. Philippe de Monsigny, CBC News, Toronto.